The grass always looked greener on the other side. So when you were a consultant, said, hey, these bankers make a lot of money. As a banker, these PE types make a lot of money. At Temasek, larger global PE guys make a lot of money. It has to be, for me, pure advisory fees. I think any model which involves a commission on stuff sold, I could not touch, and frankly, for me, it's a panacea for the industry. The ultimate nirvana is actually starting your own firm. But as you know, starting your own firm involves a hell of a lot of risks. In India, the problem with private equity in 2010, there was a plethora of firms. But there were three problems. One, it was all minority stakes. Number two, the valuations were crazy. Third, frankly, not many people were adding value. Raising the first fund is the toughest thing to do. It took us almost 2.5 years to raise about $540 million.
You do late-stage private equity investment, not so much venture capital. Any reason for that focus?
I think retail investors put alternatives in one bucket. But alternatives is a very complex composition of private credit, real estate, private equity. I believe in the power of compounding. So till I find a good manager, I believe in keeping the money in ETFs.
What do you think of, say, mutual funds? Do you invest in them?
I'm very sensitive to gross and net. I need to ensure that if I'm paying a certain fee, whether it's a management fee or a performance fee, the returns or the alpha of that manager far exceeds the fees paid. Otherwise, it's not worth taking.
Welcome to Let's Mint Money, the show where we explore the attitudes towards money of India's top business personalities. I'm your host, Neil Borate. The show is brought to you by Mint in association with Waterfield Advisors. My guest today needs no introduction. Manish Kejriwal is founder and managing partner at Kedaara Capital. But before that, he's worked at the bluest of blue chip names in finance, including McKinsey, Goldman Sachs, the World Bank, you name it, and you've been there, Manish. So let's begin your journey with some learnings from childhood.
Firstly, thanks for having me here. Thanks to both Mint and Waterfield. I think as a childhood, I don't remember really ever thinking about money. There seemed to be enough without being too much or too little. But I think as I grew older, I've got to appreciate what my parents did, because I know our income at the time was not very significant. And I think what they did is, which is the opposite, I think what our generation does, is when they didn't have a lot, they behaved like they had a lot. So we were never not given anything we wanted without getting spoiled. So I'm saying the best education, we went abroad to study, even though we won scholarships. There was always a feeling that there was money in surplus. I only realized later when I grew up, that was actually not the case. And I think I'm contrasting that today, where we pretend we don't have a lot to create some degree of humility amongst the next generation. So I think, I don't think it was an understanding well after the truth had happened, which is we did not have a lot of excess. We didn't come from a large business family. My father actually started his career with Birlas. I grew up in a small town called Brijrajnagar, which you wouldn't have heard of, in Orissa, which had one of the paper companies. And the reason we moved to Bombay was the education wasn't good enough. And that's why he started his own trading and family business. So I was always believed we were bigger shots in a manner of speaking than we actually were. But never at school did I ever feel a discomfort on affording the normal things in life. But I do know sacrifices were made to let me live that life.
Behind the scenes.
Behind the scenes.
All right, so let's come to your career. What is your first paycheck like?
The first paycheck...
and what did you do with it?
I have no recollection. It was probably... The real first paycheck was probably my summer internships at the World Bank. I did this as a junior. I was at Dartmouth as an undergrad. I grew up in India. India is very much home. I went abroad to the United World Colleges. I went to the one in Vancouver Island. And from there, I went to Dartmouth, which is a small town in Hanover in New Hampshire. And unlike the kids today who work every summer, and I know that because my son just graduated from Columbia, we never worked in the summers. We used to, travel or come home. But in your junior year, which is between your third and fourth year, I had an internship at the World Bank, where there was a small amount paid. I have no recollection what I did with the money, except I know for most people, the summer is about choosing your future. It helped me choose my future because I said, this is one thing I would not do. I was very focused at that time, international relations, government, and economics. And the World Bank, in my mind, was the best representation of the three.
Right.
I just realized, and again, not good or bad, it just wasn't the right fit for me. And that's what made me choose McKinsey after graduation. But the first paycheck, I have no idea.
So as you progress in your career and the paychecks grew larger, did your attitude towards money change?
You know, if I was to summarize it, I would say it was from greed to giving. And I don't want to pretend to be a big philanthropist, I'm not. But I would say when you started earning money, and I think till you started earning money, I don't think I was aware of money. Despite being born a Marwari, the Marwari genes came out and became legitimate a bit later in my career. But I think in the earlier part of my career, making money was very important. We were not, as I said, a very well-to-do family. There were some challenges which came in the early part of my career. So actually, on a serious note, making money was very important, not just to provide a livelihood for my immediate and broader family, but also as one became aware, and the grass always looked greener on the other side. So when you were a consultant, you said, hey, these bankers make a lot of money. As a banker, these PE types make a lot of money. At Temasek, the larger global PE guys make a lot of money. So, you know, the problem is the hills keep growing taller and taller. And I don't know what it was. Something hit me, I want to say 15 years ago. And there was then I think till then, it was, of course, the desire and passion for knowledge in what you were doing. But I would say hidden beneath that, if I'm being honest, was a greed, which may not have been explicit. I think that greed changed. I don't know if it's about having some number, because I don't think that was the case. It was a mental switch where almost over a summer, I said, you know what? It's not about this. Where suddenly the things that were important to me, what car would I show up to a meeting for or to a wedding for? What do I wear? Which watch do I wear? For the last 15 years, I've had the same watch. It's an Apple Watch. Maybe the versions have changed. I've actually moved from, we used to drive to Pune quite often, so we had a Maybach to be comfortable for my wife. That's sitting in the garage. I drive a MG Windsor. It's a much smaller car. So I think your attitude towards wealth, it goes greed, and then when something happens, it becomes completely irrelevant. So my younger son, who's a little bit more fashion conscious as I am, calls me the Uniqlo dad, because all my clothes, including what I'm wearing right now, is Uniqlo. So now you've reached a stage where no matter what incremental money you make, it doesn't affect how you spend it at all. At least to me, it doesn't. And in fact, I see life getting back more to simplicity, AKA, I don't care about the next new BMW which comes, even though we can get it. But to me, what's smaller, more efficient in Bombay, and one really stops caring about the world around you, in a matter of speaking.
You had an early episode with debt.
Yeah.
Can you tell us more about that?
Yeah, this is a perspective that haven't normally shared. I mean, a few of my close friends know it, but it's perfectly okay. Very early in my career, I was actually in business school at the time. This was, I don't want to date it, but I was at business school. And we had a bunch of family businesses in pulp, paper, textiles. My father was it had grown substantially. And at that time, it was quite normal to give personal guarantees. I didn't know better. I also signed off despite not being active in the business. In retrospect, the stupidest thing I did, but the businesses, like many in the mid-90s, did not do well. Actually, it collapsed. And I was stuck with a massive potential liability on my head. So I actually had a enormous, gigantic sum at that time of about 8 crores that I was liable for. I had finished business school, had come back to India, recently got married. And what made it worse was I was married into a family which was much more wealthier than ours. So there was a perception by the bankers that, hey, even if you don't have money, you can easily be subsidized or taken care of by the other family. I don't think these bankers knew who my father-in-law was, because he wouldn't have a minute of that sort of stuff. And one of the lessons I learned early is I could have taken a big gift from my in-laws, which I didn't want to do because I enjoyed a very good relationship with him and the family. So my point is, because of that debt, the first 4 or 5 years, when I was working at McKinsey on the weekdays, on the weekends, I was actually at a family plant, which was in Nasik. One of them was in Nasik, to make sure that's where I had the personal guarantee that we could either turn it around, which I could not do, despite thinking and trying to. So with all humility, but we managed to sell it and neutralize the debt. But that episode in my mind, because of the negotiations with the banks, there were 2 very large banks involved. And I don't blame them today, but at that time, the sort of pressure they put on you when you had a day job in the week, and I wouldn't even admit it to people at work because, it was a shame or an embarrassment. It's easy to talk about it 30 years later when it's behind you and you've got all the lessons. But it created a very uncomfortable period for 2, 3, or even 4 years. So much so that right after resolving it and making whole with the bankers, luckily because we managed to sell it, I actually went back to the US with my wife, and we just wanted to be away from India. But what it left with me, Neil, was very much a feeling that I cannot take on debt. So from a personal perspective, I've never had debt. Even we bought a house. We rented a house for many years. We finally bought a house only in 2013, when there was enough money accumulated where you did not want to take a mortgage. I don't even have a mortgage, so I'd rather wait for 10 years.
So it's 20 years after you began work.
This was 20 years after I started working.
Yeah.
I started working in 95. I got the house in 2013 or 14, but I still live. And we're very happy with the place. We'll probably be there forever. Nothing very fancy, but very comfortable and lots of great memories, which is why we'll keep it. But my point is, this moved over to work also. So as you know, in any firm, while it's good not to have debt, it also has a lot of tax advantages. So I keep telling my teams at Kedaara, and I said the same thing at Temasek, listen, there's no way, when you ask me for advice what to do with the capital structure of a firm, I will be biased and see 0 debt and 100% equity. I know that's not the right answer, but that's what you're going to get from me. So when it comes to cap structure only of a firm, do not take my inputs, but make up your own mind. However, what you're absolutely forbidden to do under no circumstances, can you give the guarantee of the holdco or the fund or the holding company of the fund to any bank. So if there's a portfolio company, and this is exactly what my father-in-law taught me, because he did the same thing in his companies when his brothers were not performing well. He could have easily stood behind them.
Yeah.
He said they've got to manage their own businesses. So I said each portfolio company, will support them in the best we can, but purely on commercial terms. We're not going to subsidize or guarantee their things. And so that's essentially how it's affected my life since on the professional side is luckily I have a bunch of partners and deal guys who can make the right decision, because my bias is always to go to 0 debt. But that was all because of the scars. And I say they're scars now, but I think the learnings that I had at that time, it was combining the McKinsey cerebral stuff with a lot of real world. I mean, I had to deal with labor doing a hartal outside the factory because they weren't paid their wages. How do you supply? So I think, even though I hated it at the time, in retrospect, the learnings in those 3 or 4 years are probably what helped me develop the steadfastness, the humility, or that, you've gone through what most entrepreneurs have gone through.
Yeah.
But the beauty is people don't know that part of me. So they think it's someone they're talking to who's always been brought up in a better wealth, as you probably thought when I walked into the door. And I'm perfectly happy to let people believe that way, because that's life.
Fair enough. Let's talk about Kedaara and your move to entrepreneurship.
Yeah.
Did that make you a little bit more cautious? How did that affect your personal finances?
You know, I think the big thing we missed in the middle, after McKinsey, which I was very happy with, there was this woman called Ho Ching, who was the CEO of Temasek. Temasek that time was not well known in India. And my first learning was actually the move I made. I learned the art of investing from her and from Temasek. And partly jokingly, made many mistakes, but it was somebody else's money, not my own fund. We had an incredible 7, 8, 9 years.
2004 on.
2003 was when I shifted. We set up the office in India for Temasek. I led that office for 7 or 8 years. Hired every person that was from the janitor to the secretary to the investment team, of which the majority of them are still there. A few have joined us, but the majority of them are still there. And there's a warmth about that place because why it was special was it was not known in India. And when I first went to a couple of mentors in India, including, well, I won't use names here, but very senior industrialists that you'll know, they said, are you crazy? No one knows Temasek here. Why would you ever do that? But Ho Ching, again, it goes back to people. It's a person who I was blown away by. I haven't seen a smarter from a more strategic than any partner I'd worked with at McKinsey, but also very positively shrewd from a structuring perspective than any partner I'd worked at Goldman. And she gave me the opportunity to set up their first office outside of Singapore. At that time, there was only Singapore, there was nothing outside. So one was the art of investing, but I'd only been a consultant before. But the other was also representing Temasek in India. I did India and financial services globally. He did China, everything in China, and telecom globally. So that's why there's been a preponderance of financial services, both at Temasek, at Kedaara, and that remains to me, from a personal investing perspective, a favorite theme, and I'll get back to that. And that's been further strengthened by my experiences on a company I sit on a firm called Bajaj Finserv, which has a subsidiary called Bajaj Finance, and I don't need to tell you how successful that firm has been. But the financial services and Kedaara were the foundation stone, which gives me, if I hadn't done that, there's no way I'd have the confidence, false confidence, or whatever it might be to take the plunge. So the two people who've always influenced me a ton was Ho Ching, and the other was my father-in-law, who unfortunately isn't here anymore, he and my father both called me the black sheep because I didn't do, I was perfectly happy at McKinsey, I was perfectly happy at Temasek. There was never a thought. Then this Kira came up in 2000. I call it a Kira because it was a Kira in 2008 or 9. I have to start my own thing. Now, I don't know whether it was greed, because again, in the hierarchy of Maslow, I was in private equity, but I was in a sovereign. I wasn't earning as much as the KKR guys did or whatever. And the ultimate nirvana is actually starting your own firm. But as you know, starting your own firm involves a hell of a lot of risks. But when Ho Ching decided to do something else, we had the global financial crisis, which had its own set of scars, especially in financial services. It made me think, do I want to do this the rest of my life, which I was thoroughly enjoying, or I'm still young enough to take a risk to start something new? So that was the background. I'm sorry, I went off on a tangent. Why? I think understanding that is critical. Otherwise, why would you start your own firm? And then also I was humble enough to sort of recognize I couldn't do this for myself. So I went out and got 2 ex-colleagues from McKinsey who were working at a great firm called General Atlantic. We combined, the 3 of us, our forces, and launched Kedaara. I would say I wanted to do controlled investments in India. I would say we didn't know how to do that. And so we went out to a firm called Clayton, Dubilier and Rice, who I knew well from my McKinsey days in New York. I also knew well because one of my closest friends from business school, a guy called David Wasserman, was one of the senior most partners. And what was the thought that time was not to do a partnership, but to do what I would say in local lingo, technology transfer. The technology transfer became a marriage and a joint venture, which I didn't expect. We changed the way private equity worked in India to do one controlled transaction, hired very senior operating partners. We had Pramod Bhasin and Sanjeev Agha to start with. Today we have Nitin Paranjpe of Unilever and Keki Mistry of HDFC. So when you look at a financial services company and an opportunity, not only does the investment team, which is rock solid, but we have the operating hands overseeing it also. So it's a mixture of financial and operating expertise which makes the deal happen. And that, I think, is one of the main reasons why Kedaara is off to a great start. The last thing I'd say is, if I was to apply to Kedaara today, I don't think they'd hire me because the quality has gone literally so high. So luckily we were able to found it, and we hopefully have a bunch of leaders right now who will take this on forever. So I just wanted to make sure you got that part of it.
So Manish, just to add on to that, you do late stage private equity investment, not so much venture capital. Any reason for that focus?
Neil, good question. I think retail investors put alternatives in one bucket, but alternatives is a very complex composition of private credit, real estate, private equity, within private equity, late stage private equity, which most people regard, but also early stage venture capital. If you just stick to those two things, because that's investing in companies, not in real estate or credit, it's a very different thing. And a good PE guy doesn't necessarily be a good VC guy and a good VC. And I'll give you the biggest difference, Neil, is in our industry, I like to say we do boring manufacturing. We do bricks and mortar sort of businesses. So we have a company which is EBITDA positive. And actually from a returns perspective, we expect each return to give us between 3x to a 5x. That's a very good return. But at the same time, we expect
in what period?
In 4 to 5 years. Think about a 25 to 35% IRR. But almost at the same time, you need to ensure there are no flameouts. There's no zeros. VC, on the other hand, if they don't have at least 50 of the companies sort of flaming out, at least getting less than one as capital back, I would say they haven't taken enough risk. So what happens in VC, you have 4 or 5, 2, 3, 4, 5, more the merrier, home runs, which are 10x, 20x, some of them are 100x, which really drive the returns of the fund, but the majority of them could end up being duds. So you need a much more of a risk-taking appetite and a willingness to believe in a concept and really help in the business building in that stage, which is not necessarily something my team would do really well. No? We know what we do. We do that, I think, relatively well, better than most. But if we attempt to do something on the early stage, that's not. The world is a very large oyster of opportunities. I think the way to succeed, and this goes across asset classes, is stick to the area that you think you know. Don't even attempt to go to the other areas. So this, I think most people talk about how we do financial services, we do consumer, we do healthcare, we do tech services. But I start off a conversation what we don't do. We don't do real estate. We don't do infrastructure. We don't do anything that deals with the government, right? We don't want to be dependent on anybody else. So actually what we're playing in is less than 20% of the economy or 40% of the economy. The other parts of the economy have people like Mr. Ambani, Mr. Adani, Sajjan, Sunil Mehta, all phenomenal industrialists. Why would I want to compete in their value chains, right? Especially on infrastructure, and which I don't understand. So we have to be humble and say we're a little red dot compared to everybody else. Play in the box that you think you know, but in that box, be better than anybody else. So that's our belief.
You've never been a shark.
I have never been a shark. I don't want to be a shark. My friend Piyush is a shark. I love the way he's on stage. But I do believe, I think it's good because people have sort of realized entrepreneurship. It's encouraged entrepreneurship. I just hope that the people who become sharks on stage or on television, that's just a small part of their lives, and they don't start believing they're sharks in real life.
All right. Let's now turn to the public market,
Yeah.
Manish. What do you think of, say, mutual funds? Do you invest in them?
Yeah. I am sort of like a barbell. I'm very sensitive to gross and net. So what are the inefficiencies of supporting either a mutual fund or a PMS? I need to understand the costs. I need to ensure that if I'm paying a certain fee, whether it's a management fee or a performance fee, the returns or the alpha of that manager far exceeds the fees paid. Otherwise, it's not worth taking. Of course, I believe in equity. I believe in the power of compounding, but I keep my life simple. I think many people think they're very good public investors. I think I'm okay or good towards choosing when to invest in a company. But given I have a day job and I believe in doing what we know best, after investing, I often forget I have that public portfolio in my investment. So while you may have gone in at the right time, you never exit at the right time. So what do? I then I believe in the power of compounding. So till I find a good manager, I believe in keeping the money in ETFs. Why ETFs? It's a good proxy to equity, but with minimal friction costs. The moment I find a really good investor so I keep meeting investors on the public side. The moment you get comfort with one, I allocate some amount of my capital to that individual because I believe he or she can do a much better job than I can.
Now, you said before that you don't really much believe in real estate as an investment. Could you walk us through why that is?
No, I believe in real estate as the asset class. I just said that me as a retail investor, if I wanted to play in real estate, I'd rather buy a REIT. And today there's the Mindspace REIT, there's the Brookfield REIT, there's a whole bunch of them. And again, it gets back to friction costs. I mean, in the past, what people in our community used to do is buy real estate, buy houses, buy apartments. I'm saying buy all that, but that I would do is where you actually want to live, or when you have enough wealth, you want to get something in the same building for your kids when they grow up. I have no issues with that. But don't pretend it's an investment. To me, if I was investing in real estate, I'd do it in an asset class which has minimal friction costs and easy to transfer.
Now, in finance, there are two kinds of intermediation. There is commission-based distribution, and then there is fee-based direct plans. How do you see them?
Listen, I have some very good friends on both. I'm a very people person, but on this one, I'm far on the right. It has to be, for me, pure advisory fees. I think any model which involves a commission on stuff sold, I could not touch. And frankly, for me, it's a panacea for the industry, because forget about the wealth industry. For private equity, one of the reasons we have not taken domestic capital is once when we talked to a couple of wealth managers and we realized the power of persuasion an RM has with his client is much more than I expected. And hands off, that's a phenomenal strength. But unfortunately, what I found many of them doing is being purely incented by the commission, so often mis-selling the product. I know my own wife was offered a certain private equity firm that I know well and guaranteed a 30% return. Now, in our industry, you can't guarantee, you hope you get 30% or plus returns, but I can't guarantee it. And I really believe one of the biggest risks to our industry is the mis-selling of these products, because ours is a very illiquid product as private equity. Once you invest, you can't get liquidity for 10 years. And if you are forced to get liquidity, you get it a massive haircut, as one would expect. So in my mind, anything that involves a commission-based selling model is one that one should be careful of. I am strongly on the pure advisory model. Go to somebody you trust. Your interests need to be aligned and minimize the commission. And I'm glad the regulators are also seeing through this. And for almost every asset class are coming out with these direct investment options, which I think in that the commissions as well as what incentivizations you have is more aligned with that of the investor. And I do think, at least in the private equity and the venture capital industry, the regulator will come down strongly on the way the product is sold. Or missold to domestic. The accredited investors, the family offices have the resources and they know what sort of risk reward they can take, how much illiquidity risk they can take. The young aspirational investor, which maybe the guy in my shoes 25 years, 30 years ago in McKinsey, wants exposure to that. Partly it's also touted by guys like you as Neil as being cute, exotic, and high returns, and it is. But people fail to emphasize, especially the RMs, with reward always comes risk. So you emphasize the reward, you don't emphasize the risk. When we go out to market as Kedaara, we emphasize the risk, not the reward. and emphasize, hey, unless you have a comfort in a 10-year product, you shouldn't be looking at this.
Absolutely. Manish, thank you so much for taking on the time. It's lovely speaking to you.
Neil, pleasure. Thank you so much.